Hey guys, Eric Wilson here, and a little bit of a different format today, but I wanted to take some time and just jump right into Excel because we're going to be talking about different return metrics that you should understand as a real estate investor. So without wasting any time, let's get right into it. I built this model. It's a really simple model. It just has some metrics on here, breaks out the year by year cash flows of a property with some simple property metrics over here on the left. So the first metric that I want to talk about isn't actually a return metric, but it's crucial to understand for the following metrics that we're going to talk about, and that's the net operating income. And the net operating income, or NOI, is a metric that measures the profit generated by a property after subtracting all operating expenses from the property's gross income. It's essentially the amount of money that an investment property generates before accounting for debt service, taxes, and non-operating expenses. So like I said, it's a critical component. I didn't break out the line items for revenue or expenses in this model. I just gave us a simple line item that generates the NOI. So we just put in 525,000. That's our NOI. That's what we're going to use for the model. And then we put in a growth rate for that year by year. So you can see that the NOI grows year over year by 3%. So that's just saying that our revenue and our expenses are both growing by 3% year over year. So now let's get into the actual return metrics. And the first one that we're going to talk about is cap rates. So what is a cap rate? Well, simply, it is a formula that tells you the return on investment that you can expect from a property based on the amount of income that it generates. So the formula is really simple in this chart here, and it's NOI, or net operating income, divided by the property value or purchase price. So in this model, we have a going in cap rate of 4.38%. Now, what that means and how we calculated that is we took the NOI of 525,000 and we divided that by 12 million, which is our purchase price. So that's why we're calling it the going in cap rate. You can also have a terminal cap rate for when you sell a property, but we'll talk about that in a little bit. So in other words, the cap rate is the ratio of the net operating income to the property value. The higher the cap rate, the higher the expected return on investment without any debt on this property. So if we bought this property in all cash for $12 million and it generated $525,000 in income, we could expect a 4.38% return. So that's the basic formula. That's the most basic understanding of cap rates, but this is where things get a little bit more interesting. Cap rates are a lot more than just a math formula. They're also a measure of risk. You see, cap rates are a way of estimating the market's expectation of a property's future performance. The higher the cap rate, the greater the perceived risk, and the lower the property value. Conversely, the lower the cap rate, the lower the perceived risk, and the higher the property value. So what does this mean for you as an investor? Well, when you're looking at different real estate opportunities, you want to look at the cap rate to assess the risk associated with that investment. There's a lot of other factors that can impact cap rates, but generally speaking, if the cap rate's high, that means the investment could be a little riskier. And on the other hand, if the cap rate's low, that means the market is expecting the property to perform well and the investment is less risky. You might hear people talking right now about the spread between cap rates and the 10-year US Treasury yield. And that's because analysts will often use the 10-year treasury yield as the risk-free rate when analyzing potential investments. So the 10-year T-bill is looked at as the risk-free rate because it's backed by the government. So if I'm an analyst and I can get a risk-free rate of 4%, I'm going to want a premium on that for investing in real estate because of the perceived risk associated with it. It is real estate after all. So the 10-year treasury is backed by the government. Real estate, there's risk associated with it. So I'm going to want a spread on that. And if we look back historically at the 10-year treasury and core private real estate, we'll generally see a spread of 150 to 250 basis points. That's a different discussion, but hopefully that helps you understand that cap rates are a lot more than just the math formula. They're more of an expected rate of return. They're more of an expected risk associated with that investment. Now, it's also important to remember that cap rates are just one piece of the puzzle when it comes to looking at different real estate investments. And there's a lot of different factors that come into play, like the property's location, the market conditions, and the local economic conditions. But cap rates are a good place to start, and they can give you a quick snapshot of what you can expect from that property in terms of risk. Moving on to equity multiple, I strategically did equity multiple next. We'll save internal rate of return, IRR, for after we talk about equity multiple and cash on cash, because I think they're a little bit easier topics to understand. So equity multiple is a simple way to calculate the multiple of your initial investment that you receive back after a certain period of time. And it's calculated by dividing the total distributions that you receive from the investment by the initial investment amount. So let's say you invested $100,000 into a property, and after 5 years, you sold it for $150,000. Your equity multiple would be 1.5. And that means you received 1.5 times your initial investment back. So equity multiple, it's a good way to measure the performance of your investment, but it's really important that to understand that it doesn't take into account the timing of your cash flows. In that same example, if you sold the property in 2 years or in 5 years, but you sold it for $150,000, you would still have a 1.5 equity multiple. If you sold it in 10 years, but you still sold it for $150,000, you would still have a 1.5 equity multiple. So that equity multiple stays the same regardless of when you sold it. It's just a matter about how much you got back in total distributions. Now, this is a key concept to understand before we go into IRR and discounted cash flows. But the basic concept is this. If I asked you, would you like $100 today or $100 a year from now? The choice is pretty obvious. You want the $100 today. But if I said, would you like $100 today or $1,000 in 10 years? Some of you still might say $100 today, but it's a little bit less clear. And the idea behind this thought process is that $1 today is worth more than $1 in the future because I can reinvest that dollar and earn a return on it. But I'm getting a little bit ahead of myself. So really quickly, I'll just point out that this is the equity multiple. We got a 1.65 in this example. This is how we calculated it up here. We took all of our distributions. So we put in $4 million. That's our initial investment. And these are all the cash flows that we received from that investment. So using the sum if function, we're able to get that we got a 1.65 equity multiple. That can also be expressed as a percent of total return, and that would be 165% total return. Moving on to cash on cash return. Cash on cash return is a measurement of the amount of cash a real estate investment generates compared to the amount of cash invested in it. All right, so it's calculated by dividing the annual pre-tax cash flow generated by the property by the total amount of cash invested. And this metric allows for a quick and simple comparison of cash flows generated by different properties. So if your investment goal is to produce an annual income, you'll want to look at the cash on cash. You can have a high equity multiple, but if you have no cash coming in years, say 1 through 5, that might not align with your goals. So cash on cash, right here, we're just taking the average cash on cash, which is in this line. And all we're doing here is we're just taking the cash that this is producing, and we're dividing that by the amount of equity that we invested. All right, now we're going to get into some more complicated topics, but they're critical to understand when you're looking at potential private real estate investments. And the first one is IRR. You're going to see this a lot. Internal rate of return, or IRR for short. It's a really commonly used metric. You'll see this in a lot of real estate investments, a lot of offerings, and it's a key decision making for a lot of investors, but it can also be a bit tricky to understand. All right, so let's start with what is an IRR at its most basic level. An IRR is essentially the average annual rate of return that's expected to be earned on an investment, but it's a metric that takes into account both the cash inflows and outflows over the period. And it calculates at the rate at which the net present value of all cash flows is equal to 0. So if you don't have a background in finance, what I just said might not mean a whole lot, but you should understand that it's essentially the annualized time-weighted return on investment. So let's talk about how the IRR is actually calculated. And Excel makes it super easy. It has an IRR function, but IRR is calculated by taking the discounted cash flows of the investment and finding the rate at which the sum of those discounted cash flows equals the initial investment. In simpler terms, the IRR is the rate at which the investment's returns are equal to the cost of the investment. But an important thing to note about the IRR is that it assumes that all cash flows from the investment can be reinvested at the IRR rate. And that's a key point because it can impact the accuracy of an IRR calculation. For example, if the investment's cash flows are not reinvested at the IRR rate, then the actual return on that investment could be lower than the IRR calculation suggests. So why is it important? Why do investors use IRR? It's an important metric because it allows investors to compare the potential returns of different real estate investments on an apples to apples basis. By knowing the IRR, you're able to determine if the investment is generating a return that's sufficient for your goals and your risk tolerance. IRR also helps investors understand the timing of cash flows from the investment, which can be really important in making any sort of investment decision. So IRR is a useful tool, but just like equity multiple and cash on cash, it's important to consider all of the different metrics and how they work together. You can have a high equity multiple when you sell a property in 10 years, but you might have a really low IRR because of the timing of those cash flows. And conversely, you can have a really strong IRR if you're producing a lot of income in the first couple of years. That timing of cash flow is really close to the initial investment, but you might have a small equity multiple or a small cash on cash. So understanding all these different metrics and how they work together starts to paint the full picture of what this real estate investment is and what it can do for you. Now we're going to jump into a bonus topic, and this one it's more complicated, but it is also essential for understanding real estate investing, specifically in private equity real estate. So let's talk about discounted cash flows. And first, let me talk about the basic premise of discounted cash flow. So discounted cash flow is a method for valuing an investment by projecting the future cash flows generated by the investment and then discounting those cash flows back to their present value. Now, the present value of the cash flows is then compared to the current cost of the investment, and that'll determine whether or not the investment is a good one. So let's talk about the discount rate. And right here, you can see I chose a discount rate of 8%. The discount rate is the rate of return that is used to discount the future cash flows back to their present value. Now, it's important to note that the discount rate represents the time value of money and the risk associated with the investment. A higher discount rate will result in a lower present value, while a lower discount rate will result in a higher present value. So if we look at our cash flows here, year one, we've got $185,000 in present value at a discount rate of 8%. We're going to discount those values to today's dollars, and that's going to be $171,296. If we go further out, these dollars are going to be more heavily discounted in today's present value. So $5.8 million in year 7 in today's dollars at our discount rate would be $3.3 million. And that's how we look at discounts. So remember when we talked about, a dollar today is worth more than a dollar in the future? That's the concept that we're talking about here. $5.8 million in year 7 isn't worth $5.8 million in today's present value dollars. At a discount rate of 8%, that 5.8 million equates to $3.3 million. Now let's talk about what that net present value means, because I just mentioned net present value. Net present value is the difference between the present value of future cash flows and the cost of the investment. So if the net present value is positive, it means that the investment is expected to generate a return that's higher than the discount rate. And if the net present value is negative, it means that the investment is expected to generate a return that's lower than the discount rate. And it's important to understand both discounted cash flow and net present value because they're two very closely related concepts, but they're not the same thing. The discounted cash flows that we see here are used to calculate the net present value. Now, technically speaking, investors should only invest in a property if the net present value is positive. However, there are several different inputs to net present value calculation that are so highly subjective and uncertain at the beginning of a hold period. Let me explain it this way. It's very difficult, if not impossible, to accurately forecast the exact cash flows that will be received each year over year during the hold period. So while the first year or two might be easier to predict, after that, the predictions of future cash flows become very uncertain. The second issue that I have with using net present value for real estate is determining the discount rate. Now, I chose an 8% discount rate right now because that's a standard to use, but it's going to base highly on what the investment is, what your required return is. An investor will choose a discount rate that's appropriate for the current economic and real estate cycle. However, these conditions will change over the course of your hold period. For example, an investor chooses to evaluate the property and interest rates are at 4%. So we decide that an acceptable discount rate on this property is 8%. All right, so we're good at here. Interest rates are 4%. We chose a discount rate of 8%. But let's say in year 3, interest rates fall to 3%. We're going to be in a good spot because we're providing an additional spread between the return versus what we're currently achieving on the property versus that interest rate. We're getting an additional spread. However, if interest rates rise up to 7% and we're still only discounting at an 8%, then this deal is no longer as attractive as it was when we initially underwrote the property. So there's numerous inputs that need to be considered when determining the different impact changes that the market would have when determining a discount rate, your future cash flows. That's why I don't love to use net present value when evaluating a real estate project. But that's also why you still need to understand it, because all of these metrics can be used together to thoroughly evaluate a potential investment. At a firm like ours or any investment firm out there, when we're putting these projections together, there are months of meetings and models that are used to try and come up with as accurate projections as possible. However, ultimately, the second that a projection is made for any project, it's going to be wrong. So as an investor, it's important to take all of the information that a sponsor is giving you, do your due diligence, and then based on all of the information available, determine if the investment is a viable one for your situation. So I hope that this was helpful and you can reference this video back when you're looking at potential investments in the future. And you can kind of start to shape how a real estate investment return looks for you based on how all of these metrics work together. Please like and subscribe for future videos on private real estate investing, and I'll see you next time.